love the channel and find it useful in becoming a happy retiree. Subscribe today. Mary, what's going on? How can I help?
I've got a bit of an inheritance along with my own funds to invest, and it could be around $100,000. I also didn't do anything. I'm having to do my RMDs now, and last year's it's just sitting in a money market fund because I'm afraid of putting it into the market because the market keeps going up, and you're not supposed to buy high, and I don't want to buy high, but it keeps going up, so I'm
right. It's frustrating, isn't it? It really is frustrating.
It is.
Welcome to the world of investing, and I think everybody listening probably has some sort of you feel what Mary's talking about here, right? It is a frustrating position to be in. And Mary, and we think of it a lot of times in terms of, hey, the stock market is at a high. Well, to some extent, look at the bond market too. When rates are low, like they are today, that means bond prices are elevated. So it's the same story on the bond side of the equation too, right, Mary? So
yes,
there's a lot to think about.
That's part of my issue. I've got a traditional IRA with over $600,000, and 50% of that is in bonds. And the bonds, the valuation every month with my statement is cutting off of the increases I've gotten from the mutual funds. The rest of the money is in. So I'm not happy with the bonds. So I'm just at a dilemma as to what to do.
Well, there are probably 1,000 people listening that are think of the same thing, and I know it's a really frustrating place to be. Now, a couple of thoughts moving forward. I always go back to kind of these fundamentals, and if you are taking your required minimum distribution, so that means you're probably in your 70s. Is that right?
Yes.
Okay.
Yes.
Now. But your question though has to do with something to do with your son and some What was the initial question?
Oh no, it's just I have money to invest. I don't need my RMDs to live off of. I have a pension and the Social Security, so it's a lot of extra money I don't need, but I don't like it just sitting in a money market account either.
Enter in a problem that is, again, a decent problem to have, right? So out of all the problems that Mary could have, not quite knowing where all this extra money needs to go it ranks as not the worst problem in the world, but a problem nonetheless, Mary, and that's why you're calling here on a Sunday morning. So you've been taking your required minimum distributions. Again, if you're younger and haven't heard of that, it's just when you're in America, you get to be 70 and a half and you have money in a retirement account, an IRA, not a Roth account, but a retirement account. The government says, look, you've got to take about 3.7% per year that first year out. So and it counts towards income. The IRS collects taxes, and then you are left with, of course, the money free and clear what to do with it. In Mary's case, she's been forced to take her required minimum distributions out of an IRA, and she hasn't reinvested it because she doesn't know what to do with it. Is that about right, Mary?
Yes. Mm-hmm.
Okay. So I would look at it this way. You have Social Security. Did you say, do you have a pension?
I have a pension also, yes.
You do? So you really are not even living on your investment money?
No, I don't need to.
So, okay. So if you don't, and again, planning and investing always goes back to what's important for you. It's not necessarily, the answer for Mary isn't necessarily the answer for somebody else. But in your case, and there's a lot of investors that find themselves in this position too, you technically don't need the $600,000 in an IRA. So
right.
Now, again, you're going to continue to have to take the required minimum distributions. It's income. You pay taxes on it. And it's moving it from one bucket to the other. It's moving from an IRA bucket into an after-tax bucket. But really that money, because you have Social Security and you have a pension, and that covers everything you need to spend, Mary, really that money is for the next generation, isn't it?
Well, yes, I do plan on leaving it to my sons and grandchildren, but I might want to enjoy a little bit of it myself.
Okay. Well, so then the money it does have, there are some things that needs to go to. So you have two goals then. You've got your family goal, which is you have sons, and then they have kids, you have grandkids, and that money is now a legacy for them. Now, you also probably are not spending as much as you could. So you should be able to enjoy it. So you should, if you want to take a trip around the world twice this year, you can you can afford to do it.
Well, I've already been to Barcelona and on a safari, so I'm not.
Where are you going next year?
I'm working that out with some cousins. It'll be a European trip.
Okay, so you're doing what you should be doing, and the reality is this: we go back to, is the money going to run out? And if you're in your 70s, you're taking, let's call it 5% a year out, which is more than the required minimum distribution, then that's going to be, call it around $30,000 a year, right? Your RMD is probably a little bit less than that.
Oh, definitely, yeah.
So you could take 30, and that's only 5% a year, and you're already in your 70s. And if it's invested, whether it's both stocks and bonds like you have today, it sounds like, and the stocks are paying dividends, then over time, you have a very, very, very low probability that the money's going to run out. So
I'm not afraid of it running out. I just want to know what to do with this extra money now.
Well, so what's the percentage of this extra money? If you've got all this money, $600,000 that's in an IRA, are you talking about $20,000 that's just sitting in checking, or is it a lot more than that?
Over $100,000.
Oh, so it is a lot.
Yes.
You know what? A couple of things. So if you've already have the 600 invested, and let's say half of that is in the stock side of the world, and I'm going to talk about stocks as we go on today a little bit. I want to talk about dividend increases, and then the other side is bonds, and then you have this other 100,000. If you're really nervous about getting it to work, then it's okay just to stick the money in a CD, Mary. It's okay, and you can get. The CD rates have gone higher and higher as the Fed has begun to raise interest rates a little bit. So you can get 1.5% in a CD, and you can then just patiently wait and reassess. And if stocks go back down, you can always get back into the market and find bargains at that point. But I also look at this and I say, well, there are a lot of companies that are still paying this 2.5%, 3% a year in dividends. And to me, that is a safe way to have my money invested, even if we go through corrections. So we're going to have a 10% correction at some point. We'll have a 15. We might even have a 20 at some point. Now, that'll probably take more of a recession, Mary, to do that, as opposed to just a garden variety correction. But you've got to get comfortable with the fact that even though we go through these undulations in markets, as long as you own companies that are still paying steady dividends, it's okay to have the value bounce around a little bit or go lower in a temporary fashion. I think about a company like Caterpillar, and Caterpillar has 600 million shares outstanding, Mary. When they raise their dividend by a penny a share or a penny a share a quarter, which might not sound like a lot, here's the math, though. Think about 1 penny per quarter is really 4 cents per share. Again, still doesn't sound like a lot, but that in itself on 600 million shares is a $24 million increase to what that company pays out to investors. And that's on top of the existing dividend. Today they pay $3.12 per share, which is almost $2 billion a year out to shareholders. So you've got to really look at these companies for what they produce on a consistent basis, as opposed to just the undulation of the price itself. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.